AM, knowledge of finance principles and processes. FP&A professionals support strategic planning, budgeting, forecasting, performance analysis, and resource allocation across organizations. Finance principles provide the framework for understanding how organizations generate value, manage resources, evaluate investments, and maintain financial stability. Core finance processes include planning, forecasting, reporting, budgeting, financial modeling, performance monitoring, and decision support activities. FP&A professionals integrate financial and operational data to help management evaluate risks, allocate capital efficiently, and improve profitability. Strong understanding of finance principles enables organizations to support sustainable growth, improve financial discipline, and enhance long-term strategic decision-making in competitive and rapidly changing business environments. Financial planning and analysis, FP&A, is one of the most important finance processes because it transforms financial and operational information into actionable business insights. FP&A functions include budgeting, forecasting, variance analysis, financial modeling, scenario analysis, and strategic planning. These activities help management evaluate performance, identify operational risks, and assess future business opportunities. Effective FP&A combines historical financial information with operational metrics and external market data to support data-driven decision-making. Modern organizations increasingly use integrated FP&A platforms and enterprise systems to improve collaboration, forecasting accuracy, and reporting efficiency. Finance professionals must understand both accounting information and operational drivers because organizational performance depends on the interaction between financial results and business operations. Budgeting and forecasting are central finance processes that support organizational planning and performance management. Budgeting establishes financial targets, resource allocations, and operational expectations for a future period, typically annually. Forecasting continuously updates projections based on current performance, revised assumptions, and changing market conditions. Organizations increasingly use rolling forecasts and scenario analysis to improve flexibility and responsiveness in volatile environments. FP&A professionals compare actual performance against budgets and forecasts to identify variances and recommend corrective actions. Effective budgeting and forecasting processes strengthen accountability, improve coordination between departments, and support strategic execution. Modern finance teams also integrate operational planning with financial planning to align business activities with long-term organizational objectives and performance expectations. Financial modeling and scenario analysis are essential finance processes because organizations must evaluate the potential impact of strategic decisions under different assumptions and conditions. Financial models simulate business performance by incorporating revenue projections, expense assumptions, cash flows, investment costs, and financing structures into analytical frameworks. FP&A professionals use scenario analysis to assess best case, base case, and worst case outcomes for investments, acquisitions, market expansion, or operational changes. These tools improve risk assessment and support strategic decision-making by identifying potential financial consequences before decisions are implemented. Sensitivity analysis further strengthens financial evaluation by measuring how changes in variables such as interest rates, sales volumes, or costs influence financial results and organizational performance. Performance management is another critical finance process because organizations must continuously monitor operational and financial results against strategic objectives. FP&A professionals use key performance indicators, dashboards, variance reports, and benchmarking analyses to evaluate organizational performance and identify areas requiring improvement. Performance management integrates financial metrics with operational drivers such as productivity, customer retention, sales growth, and working capital efficiency. Effective performance management systems improve accountability, enhance communication, and support continuous improvement across departments. Modern organizations increasingly use technology platforms, predictive analytics, and business intelligence systems to provide real-time performance visibility and improve decision-making speed. Linking operational performance with financial outcomes strengthens strategic alignment and organizational execution capabilities. Risk management and capital allocation are fundamental finance principles because organizations must balance profitability objectives with financial stability and long-term sustainability. Finance professionals evaluate risks related to liquidity, market volatility, interest rates, credit exposure, and operational uncertainty. Capital allocation decisions determine how organizations invest financial resources across projects, operations, acquisitions, or strategic initiatives to maximize shareholder value. FP&A teams support these decisions through discounted cash flow analysis, return on investment calculations, and risk-adjusted performance evaluations. Effective finance processes ensure organizations maintain sufficient liquidity, manage debt obligations responsibly, and allocate resources toward activities generating sustainable long-term returns. Strong financial discipline also improves resilience during economic uncertainty and changing market conditions. Technology has significantly transformed finance principles and processes by improving automation, data integration, reporting speed, and analytical capabilities. Enterprise resource planning systems, business intelligence tools, cloud-based FP&A platforms, and artificial intelligence technologies enable organizations to process large amounts of financial and operational data more efficiently.